We don't know whether the rupee has seen its worst or is there more weakening. So in all of these things, it's very difficult to actually quantify how bad things can be.
So there is a silver lining to it.
We don't think we are likely to see that kind of crisis because finally the underlying fundamentals of our economy are very strong. With that as a backdrop is where we are seeing value.
Hi everyone, welcome to Deep Dive, where we explore the philosophy behind mutual fund houses. I'm Nivedita, and today I'm joined by Mr. Shriram Ramanathan, the CIO of Fixed Income at HSBC Mutual Fund, to understand what shapes the world of debt. Before we begin, I have a question for you. What makes you curious about fixed income? What is one thing you've always wanted to know about fixed income mutual funds? Drop it in the comments. Thank you for joining us today, Mr. Shriram. I'm really glad to have you here today. And I'm very curious to know about your approach towards fixed income and unpacking your entire approach. So I read a little bit about you. And it seems like you've always had a passion for fixed income, and you have an engineering background in education.
I did my electrical engineering ages ago. 97 is when I finished that. I'm not sure if you were born at that time. But post that, in fact, I worked with L&T in engineering side on the electrical side, one of the best places to be post your electrical engineering. But then subsequently decided to do my MBA, came out in 2000. That's when really a little bit by coincidence, because one of the best jobs on campus was in those days ICICI Limited and their treasury department, which used to have the cream of all the MBA pass outs really getting into there. So joined there, and from there on I think I've been in fixed income. So you can say from pretty much for the last 26 years I've been associated with fixed income. Although just to run through the journey, so ICICI Limited was there. I think then of course I stumbled onto an opportunity with one of the really small but promising mutual fund entities, which was Zurich Mutual Fund. And really that was a privilege because that had some of the best people really of our industry over there, whether all the likes of Prashant Jain, Santosh Kamath, all of them were all there. So really one of the best places to be at that time. So was with Zurich Mutual Fund, then moved on to ING, and then of course the journey continued overall. Yeah. So
all right.
You can say about 25, 26 years in fixed income overall.
Okay, so that's quite fascinating. Now, can you tell me what exactly piqued your interest in fixed income?
See, I think in those days, fixed income was a bit of a very specialized niche area. Not many people would venture into that. You had a few foreign bank treasuries, you had places like ICICI Bank, and of course, that was pretty much bulk of it. So one of my cousins was with a foreign bank, Stan Chart, and he was in the treasury. So that's where I got to know a little bit in the late 90s that, it's a fairly exciting area, growing area. And like I said, for me, really, the thing was about post-college, really getting into ICICI Limited treasury, because that's where in those days you had the best of minds in derivative research and FX side, on the trading side, and that really cultivated the whole interest for me into fixed income. Also obviously a lot of math involved and all that, and generally if you like maths and if you're good at it and all that, automatically you take a liking to it. So one thing led to another, but I think somewhere I knew that there was a growing area, and which is what, like I mentioned, getting into mutual funds and seeing the fixed income side of mutual funds. I pretty much knew over the next 2, 3, 4 decades there's going to be a massive area, and it's good to get into that overall.
Oh, okay. So it seems like you made a pretty good call that worked out for you.
Yeah, at least it worked out for me. Yeah, yes.
So since you have more than 25 years of experience in fixed income, and you've been through so many market cycles, you've been through so many rate cycles as well. So can you tell me how all of these experiences have shaped your approach towards fixed income today, especially as a CIO?
The thing is that over the last 25 years, we've really seen a lot. I can tell you in the early 2000s, for example, interest rates used to be at 11-12% in those years, 13%. And I remember a massive rally from 2001 to 2003-4, where interest rates literally came down from double digit to I think 8% or lower. And those were massive capital gains to make, right? So the treasuries across, whether it was ICICI, whether it was all the foreign banks, we made tons of money on that whole downward move in interest rates. But then obviously after that, things stabilized and we started evolving into a more lower interest rate regime country. For me, obviously, a big learning was in 2005, I got the opportunity to go to Hong Kong from ING. So 2005 to 2010, for 5 years, I was on the emerging markets side with ING Mutual. Again, a fantastic experience, because that had multiple things. It had a period wherein Asian and emerging markets were the rage. So a lot of money was coming into this asset class, which was a very new asset class at that time.
Oh.
And we really had the privilege of managing a lot of money, growing money in that sense. But also we got to see the whole global financial crisis unfold itself, and really Hong Kong and global markets were at the core of it all. So the kind of chaos that we saw, being able to deal with all of that was itself once in a lifetime experience in many ways. 2010, of course, I came back to India, home calling kind of a thing, and really was fortunate to be with an entity like Fidelity. Again, they had a good local presence in those days over here, but also globally a giant, and was really looking forward to growing their India franchise and being involved with their emerging market side. But as luck would have it, of course, they sold the business in 2012 to L&T Mutual. So I became part of L&T Mutual, and then L&T itself sold off the business to HSBC in 22. So I've been there pretty much, you can say, at the same place from 2010 onwards. Of course, the name of the entity kept changing based on the owner. But through all of this, of course, we have seen so many crises. We saw the 2013-14 crisis where India was part of the fragile five, a very weak macroeconomic backdrop for us, and how we came out of that in a way. And then, of course, the other challenges, be it the taper tantrum, be it the COVID episode, be it our homegrown credit crisis that we had in 2019-20. So that itself was an unbelievable experience, because we had our a lot of outflows from all credit risk funds, and at L&T Mutual Fund we were fairly large in the credit part. We had almost a 6,500-7,000 crore book at that time. But irrespective of who you were, we saw crazy redemptions, and COVID lockdown had started. So literally sitting from home and trying to sell thousands of crores of assets every day to make sure you meet your redemptions was itself again a once in a lifetime thing. I won't call it an opportunity. Obviously, you don't want to go through that again. But it's an unbelievable experience, and making sure that you're able to still survive, because at that time it was all about survival. And then, of course, growth comes. Then, of course, like I said, the sale to HSBC Mutual Fund happened. And since then, we have not looked back. We are almost a 1.5 lakh crore asset manager now. But yeah, it's all of these kind of experiences, whether here or whether overseas, being at the right place at the right time in a way. So I've been fairly fortunate in that side to have seen all of these things, and it shapes up your way of thinking about markets and what your own philosophies over a period of time.
Okay, so it was really interesting to hear about how you've been through all of these crises, and it seems like the market is still pretty resilient long term throughout all of this. Now, I want to ask you something about the current market scenario. I just want to ask you, what do you feel about the rate cycles right now, given the current market scenario and what's happening globally, and due to inflationary pressures and the rupee and liquidity concerns as well? So what do you think of the current market scenario when it comes to these global rate cycles right now?
See, I think we're obviously in a very, very rapidly evolving phase of markets. Very difficult to predict, and very little visibility as well, because day to day we are seeing things getting announced, markets either reacting to it initially and all, but nowadays we don't even see the markets reacting to the positive side, because the worry is that there's really no clear end in sight to the high oil prices situation and the volatility that is there. So in all of these things, as far as India is concerned, I think we are in a somewhat of a challenging macroeconomic period, because we are obviously dependent on capital flows. We are a current account deficit country, so to that extent volatility does impact our currency. Secondly, we are also obviously very dependent on imported oil and other related commodities, and that also impacts us a lot. And thirdly, we are not part of this whole AI boom and AI capex excitement that is right now gripping the world. So on all these fronts, offshore money, offshore capital coming into India, there are challenges to be able to attract meaningfully, and which is what from our own rates market and all, because for interest rates, one of the key variables that impacts us, the currency.
Yes.
So as long as the currency remains under pressure and there is an expectation of weakness in the currency, our bond markets and money markets also price in that uncertainty, which is what we have seen over the last couple of months. Interest rates have moved up, be it on the very short end, be it on the 10-year GSEC as we speak is about 7.05%. It's up almost 40 basis points from the where we were earlier. So interest rates are moving a little bit higher, partly because of the nervousness that is coming from the currency side, and partly because oil prices, which are very high, it seems like a matter of time that over here too the government might announce fuel price hikes. We don't know whether they will, but that worry is getting priced in by the markets, which means it can lead to inflationary pressures, right?
Yes.
So all of these things is what is keeping interest rates somewhat higher. So overall, like I said, it's been a challenging time. But right now, if you really see where our markets are, you could argue that a lot of the worst things are priced in. Right? And that's the nature of markets. Whenever worry grips, panic grips, you see markets suddenly pricing in, expecting the worst. And that's where really our bond markets are kind of getting into that territory, which actually starts making markets look fairly attractive.
So
I see. It's not because the worries have stopped. Yes, the challenges continue. We still don't know whether at what point the war will stop or oil will come down. But it's more the valuations part of it that suggests that, hey, if the worst is priced in already, how much more bad can it go after that? So, and that's where the reverse trade, which is basically going long in terms of duration, going long in terms of bonds, at least starts making sense. We're still maybe not there, but we are evaluating now opportunities with a very positive mindset that valuations are attractive. And typically when you get in, when valuations are attractive, when the worst is priced in, when there's panic, that's when you make money on a trade, right? It's usually the other way around, that when people jump in because the story is so good is where it's the end of the bull market. Here we are talking about the other side. People are very bearish, a lot of worries priced in, and really I think we see it like more like an opportunity, and that's what we are looking out for over the next few months. When is the right time to really load up on duration again and to be able to make money on the bond and fixed income market.
So there is a silver lining to it.
Yeah. The silver lining is that things can't go worse than where they are. So in terms of our market. So see, in all of these things, one thing to keep in mind is there's always a few periods wherein we are talking about a crisis zone. We have seen that 2008-9, we have seen that in 2013-14, and again in 18-19. We don't think we are likely to see that kind of a crisis because finally the underlying fundamentals of our economy are very strong. Right? We are a good growing economy with maybe a 7% growth can come down to a 6.5%, but it's still very good in terms of the global context. Our overall policy frameworks are very strong, be it in terms of inflation targeting, the central bank, the reserves position. So all of these fundamentals, foundations are very strong, and which is why we are kind of taking a call that we are unlikely to get into that very India-specific macro crisis zone because of strong fundamentals. And if with that as a backdrop is where we are seeing value, right? So that's that, but it's still something to keep in mind. You can't rule out more pain, but once you're closer to the upper end of yields where a lot of negative news is priced in, it starts, something will change. We don't know what. Now, for example, today suddenly we had a few announcements coming from the government, at least rumors of a few announcements, I would say, which suddenly made the currency also stronger and yields also moved down a little bit. So these are the times when suddenly the momentum can shift based on policymakers' decisions, and we could be pretty close to that is what we feel.
Okay, so that sounds reassuring. And since you mentioned RBI, I just wanted to ask you, what do you think of RBI's stance in the next few quarters? Right now, they seem a little cautious. So what do you think about the monetary policy in the near future?
It's a tricky call for the Monetary Policy Committee. And obviously, one has to appreciate the kind of difficult spot that they are in. Because if you look at a few of the parameters that they are assessing, let's say, one is that obviously all of these uncertainties also have a negative impact on our growth, right? And when there is a negative impact on growth, monetary policy and other policymakers somewhere need to be mindful of that and be growth supportive, which argues for easy conditions to continue, rates to remain low. But the flip side is, these are the same times when oil price pass through, oil prices remaining high, currency weakness, and because of that imported inflation. And to add to all of this, we are worrying about a maybe risks of a pretty bad El Nino, which can impact food prices as well over the next 2-3 months.
Okay.
So all of this means that inflation risks are also fairly elevated.
All right.
So for them, it's really a tough choice. Do they err on the side of supporting growth and say, okay, let's keep rates steady, or at some stage do they start getting more mindful of the fact that there are inflation risks and maybe rates need to be higher accordingly. So I think from now on, each policy that we are going to see is going to be a very tricky call, and somewhere going to be finally a very a judgment call that would be there. Our sense is that we are probably going to see rates remain unchanged through the rest of this calendar year. It is, let's say, one that we have to keep reevaluating. It's not a given. Somewhere into 2027 is where we see a couple of rate hikes come into play, but at least in 2026 we think rates are probably going to remain stable. But if you look at what our markets are pricing in now, markets are pretty much pricing in at least a couple of rate hikes by December. And that's where, like I said, we see a bit of opportunity here. Markets are very negative. Markets are pricing in the worst, like I told you earlier. We are not that negative, which is why we think there is a turnaround, there is a potential to make money. And we are just being patient about it. And we think over the next couple of months, we might get that opportunity.
Oh, okay. So you mentioned that there is a potential to make money. Now, in the midst of all of this, how do you identify long-term opportunities? And especially when there is so much short-term volatility, how do you deal with that and make decisions that support long-term opportunities?
No, I think that's a very good question, because at a time like this, with so much uncertainty, it's very difficult to quantify each of the parameters that you're trying to analyze, because you really don't know, for example, when the war is going to end. You really don't know whether oil will come down to $80-$85 or lower, or can it spike up to $120-$130, because every day we just wake up in the morning and see, okay, where the markets are. Similarly, we don't know whether the rupee has seen its worst or is there more weakening. So in all of these things, it's very difficult to actually quantify how bad things can be or at what point the turnaround is going to happen. At times like this, I think it makes sense to change over and look a lot more at valuations to see what is priced into the markets. And which is where, like I said, if you look at, let's say, a simple thing like a 10-year government bond yield, right? That's what we look at to gauge a lot of things. We're already at 7.05, 7.1% kind of a 10-year GSEC level. Typically, if you're above 7%, you remain there for very limited periods of time if you look at the last historical analysis. And somewhere around the 7.25 to 7.5 zone are usually good buying periods, because typically you end up making money if you buy at those ranges. And the only thing is you need to be prepared for the volatility that can happen. Maybe you take a little bit of pain after that, but you have to just sit patiently with that trade, knowing that as the dust settles, finally levels in our economy do move down back to below 7%. Same way, if you look at a more riskier part of our market, which is your 30-year government bond. I mean, usually that's a much longer duration paper, which also means that it is more volatile. So it reacts a lot more in terms of prices when interest rates go up or down. So you can lose more, you can also gain more. If a 30-year government bond today is at, let's say, around 7.6% yield. Typically around the 7.75 to 8% is again a very good zone from a long-term charts perspective. You see, those are regions where you end up making money if you're patient with it for the next year, 2 years. So that's the way we are looking at markets. The other area to look at is, let's say, a typical 2-year AAA corporate bond, right? I mean, that, for example, trades today almost at a yield of 7.75. Very rarely have we seen that trade about 8% over the last 10-15 years. So in all of these segments, we are close to those highs, that tail end of the distribution in a way, wherein it makes sense to, if you have the risk appetite, to get position, take the volatility that follows, because like I said, it's very difficult to quantify the risks and say how bad things can be. But these are all regions where, so long as our macroeconomic fundamentals are strong, the dust is likely to settle maybe in 3 months, 6 months time, and that's when really these trades will start paying off. So that's the way I would look at a more slightly longer term positioning. But for that, you need to have the risk appetite. You need to be able to take the fact that the trade may not start working on day one. We might have to wait a little bit before it starts working, and maybe in between there might be a bit of pain as well. But over a period of time, a year, 2 years, typically these are zones where, yes, there is potential to make money, and you then just be patient about it. So I think this is a classic time to shift your focus to that kind of an approach rather than take a very short-term approach to your question, because it's very difficult to figure out what's going to happen next week or in a month's time and try and take a trading call to get in or get out. I think it's very difficult to do that in this kind of a market environment. It's a time to take a more measured long-term call. Fix your levels at which you think it makes sense to get in, similar to share prices. I mean, where you target a level. Same way in bond deals as well. Target a level above which it makes sense, and then you put your position and then just wait patiently.
Thank you so much for explaining your investment philosophy.
Thank you so much for having me. Typically, investor will end up paying 30%, 35%, 40% taxation.
Which is a lot.
It eats up so much of what you make. So you
Yes.
might get into even a 12% yielding AIF, for example. What you get in hand is like 7.5%, 8%.
I'm intrigued by your mention of SIF. Can you tell me what this product is about?
I think what SEBI is trying to do is come out with a specialized investment fund category to try and make it the best of both worlds. Our idea is to have a product which beats inflation handsomely and can become a part of your core asset allocation.
Mutual fund investments are subject to market risk. Read all scheme related documents carefully before investing.